There has been a lot of volatility in the banking and financial world. First, we saw SVB Bank close, then Signature Bank, and then we got word on Suisse, Credit Suisse, which is a large Swiss bank, that they are in big trouble and have liquidity problems. All of this happening in just 2 weeks' time, which has caused lots of doubts, lots of uncertainty in people's minds, and just an overall distrust in the banking and financial world of this country and in other parts of the world that have banking as a big part of their economy. But ironically, interest rates came down in the last 1 week and a half, and we saw a little boost in the real estate market. So in today's video, I'm going to share with you the overall health of the current housing market and discuss where the future of the mortgage interest rates will be with the Fed's meeting. I'm shooting this on March 20th, and actually Fed's meeting is tomorrow and the day after. So by the time you watch this, you will know what happens. But in today's video, I will discuss where these interest rates will be in the near future. So let's get started. So let's quickly summarize what's really happened in the last 2 weeks to get a better understanding of how all this panned out. So number one, SVB Bank, which is Silicon Valley Bank based here out of the Bay Area, closed about a week and a half ago because they had big liquidity problems and nobody wanted to bail them out. Word got out really quickly. The normal public, people that deposit money in there, starting to pull money out. Their stock got devalued and they could really do nothing. It was just a perfect storm. And all of us in the market or out of the market or here, just normal citizens of this country, just felt that we were really out of luck here and the dominoes were just about to fall and this was the beginning of something bigger. But then the government stepped in and pretty much bailed them out by saying that, okay, well, whatever deposits the FDIC is not insuring, we will guarantee that everybody gets their money back. And in that case, and after that, hope was restored. Well, then we thought there is turmoil in the market and this may cause the rates to go higher. It will impact other markets in this country. Real estate will completely slow down. But the opposite happened where interest rates adjusted and went down a little bit and real estate got a little boost because the rates went down. And the primary factor of this was because investors that got word of this, that their money may be at risk at these banks, started to pull money out and started to put money into US Treasury bonds. And as the Treasury bond yield went up, interest rates started to come down because that relationship is inversely proportional. So that caused people to come back in the market because interest rates had come down closer to the 6% range as opposed to where they were a week ago before that at the 7% range. Then we got some crazier news that a bigger bank, Credit Suisse, which is a Swiss bank, which is 3 times bigger than SVB Bank, they manage about 574 billion in assets, has huge liquidity problems. No one's there to help them out. Their largest investor, which is a Saudi bank, didn't want to even put more money in there and get more stock from them or invest more money because they were right below the 10% mark of investment that they had in there. And if they got a larger chunk of the bank, then they would have to worry about regulatory issues, and they didn't want that. So there was that scare, and we all felt that this bank was going to collapse. There are 50,000 employees that may lose their jobs, but hope was around the corner. UBS Bank, which is another Swiss bank, a competitor of this bank, bought this bank and did a big merger for $3 billion. So this could be great news for the general public, for the consumer. Probably not the best news for investors because who knows how they're going to renegotiate their contracts and how the forecasting is going to look for the people that had invested in this bank. That's a topic for another day. But for now, we can say that some hope was restored there with this merger happening with Credit Suisse and UBS Bank. So what has all this caused? Well, number one, scrutiny for the banking world. After the collapses of Signature Bank and SVB Bank, and now with what's happened with Credit Suisse, it's caused all eyes and a spotlight to go on this sector, which has devalued a lot of stocks, dropped stock values for a lot of banks that are traded in the open market. And then also what it's done is that investors that have parked their money in these banks are now looking for other avenues and other areas to invest their money in to keep it secure. So you're seeing a lot of these people are investing in bonds, or a lot of people are just diversifying and separating their deposits throughout different institutions to make sure that their money is secured by FDIC. If you're getting real value out of this video, please hit the like button, because when you hit that like button, more people like you that need to be shown this video is shown this video by YouTube, and it just makes me feel good because I love to see that like from you. And if you want to stay on top of your real estate game, hit that subscribe button. Thank you for watching. And number two, there may be more banks out there that may have the same fate as these banks, as investors and depositors start to withdraw money and they start to lose deposits from these banks. There may be other banks out there that may have major liquidity problems, because deposits is a big part of the banking business. And number three, which kind of goes with our first point, even though the general public may have distrust and just there's an overall scare in the market where a lot of people are on the fence, are not trying to do anything, they're just hiding behind curtains or, under their covers. A lot of savvy investors or educated investors that have money in the market are looking for secure vehicles to park their money in, and real estate is one of those vehicles. So real estate may start to see a little boost in their sales going forward. Now, for today's video, I don't have tangible data to discuss, because this all has happened very, very fast, and it's just happened. We're gonna need at least a month or 2 months of full data and sales to actually see how this boost has happened, because as we all know, historically speaking, real estate makes money on a long-term horizon. Now, if you're looking to park this money for a short-term period and the property is devalued, well, you can have liquidity problems. But if investors are looking to park their money for 5 to 10 years, real estate is a great platform and great vehicle to park your money in, because as you know, in real estate, money just doesn't go poof overnight. You can lose value, but eventually it will come back. So if you're parking it for the long run, it is very, very safe to put your money in real estate. And they for sure are not making more land in this world. So real estate is a very attractive vehicle for a lot of investors, but I'm very interested to see how this will impact the real estate market in the coming months. Talking about a small sample size, in my business, I've had a lot of investors that have portfolios of 5+ or more properties, investors that know how to invest in real estate, have invested in the real estate market before, and have money parked in banks in liquid form, have made calls over the last week and a half asking about markets outside of California, markets like Austin, Houston, Dallas, out in Texas, Arizona, where where there's still an upside to make money and also buy real estate and make significant profit on rent. So that is definitely happening in my brokerage practice, but it's going to be interesting to see how the number looks on a larger scale as we move forward. Now, a question on a lot of people's minds: what will the Federal Reserve do? Will they continue to increase rates? Will they slow down? Or maybe will they bring them down to help the banking world? And as you all know, when interest rates go up, banks are significantly impacted negatively, as we have seen here, what happened with SVB Bank, what happened with Signature Bank, and what happened with Credit Suisse. A lot of this has to do with interest rates going up, and with interest rates significantly impacting these banks negatively. Now, if you want to know exactly what happened to SVB Bank and how their liquidity was impacted, check out the video above where I go in detail talking about what actually happened, and it translates to why Signature Bank also closed. As I've discussed this in my previous videos as well, the Federal Reserve's main responsibility is to conduct monetary policy, which translates, and it means that they have to, or one of their major functions is to promote maximum employment, stabilize prices throughout the country, and make sure they moderate long-term interest rates. So if they stay true to that function where a lot of speculators in this country, a lot of economists are predicting that they will raise rates in the next Fed funds meeting, which is tomorrow. A lot of other economists in this country are predicting that they may not raise rates because, like I just mentioned earlier, it could have a negative impact and further worsen a lot of the banks in this country. I believe the Fed will raise rates by about a quarter point. Now, I'm not talking about mortgage interest rates. I'm talking about the Fed's fund rate. We don't know exactly how this will translate with the mortgage rates, but you'll know very quickly because banks will adjust their margins. But the Fed's funds rate, which is the rate that banks transfer money and trade money with, that's their borrowing a number. That Fed's fund rate will go up by about a quarter. The Feds had made it very clear 2 weeks ago in the press conference that they're going to be very aggressive, indicating that it's going to be more of a half a point. But with the current situation that has brewed in just the last week and a half, I believe they may readjust that and raise about a quarter point. Now, inflation did come down a tad bit from 6.4 to 6% in the report in February 2023. But the Fed's goal is to bring the inflation down to 2%, and we're pretty far off from that. So I believe they will continue to raise rates. Devaluation of money can be a very big problem, guys. More problematic than a banking crisis, although I'm not underplaying that situation at all either. But if our dollar just starts to diminish value, it can really impact the middle class and the low-income earning people in this country, and that's going to be a big, big problem. So I know we're all hoping for a soft landing, and it just got rougher, but I believe it's needed right now for these rates to go up, for it to impact prices, for prices to come down. And what happens during a time like this? Opportunities are created because a lot of people, most people right now are going to be on the fence. Most people are scared. When rates go up, there are less buyers out there. When banks start to close, there are less buyers out there because people are scared. So if the numbers work for you, this may be a time to just go out there and make that ridiculous offer, to offer a lower price because there's less buyers out there and that seller needs to sell. Let's face it, we really have no control over the market. Markets are going to do what they do. It's just like life. Things happen where we have absolutely no control over them. The only thing that we can control is our emotional response to what is presented to us. So definitely keep your eyes open. Run your numbers with the loan officer today to know what you can qualify for and compare that number to how much rent you're paying. And if you were to rent out an identical apples to apples kind of home, if it's an apartment, if it's a townhome, or if it's a single family home, what are your market rents? And compare it to that mortgage. If the numbers make sense for you, this may be a great time to pick up a property where buyer activity is very low and you have an ability to negotiate and make that offer work in your favor. That's all I have for today. Until next time, this is Karan Singh.